In this video, we're going to talk about how to account for premiums and coupons that firms sometimes offer. So we know that firms will give incentives to customers in order to purchase their product, and these incentives could be some kind of mail-in rebate. They could be if you submit X number of cereal box tops or X number of wrappers or labels, and then we'll send you a free toy. These types of things. These are just incentives to get customers to buy. But when firms offer these incentives, it's very likely that they're going to have to accrue a liability. And the reason is, again, if we come back to what a liability is, basically there's an obligation of the firm to sacrifice assets. Right? So if the firm says, okay, you redeem X number of box tops, we'll give you a toy, well, now the firm is going to have an obligation. But we have to be able to determine a couple things. If we remember our talk from contingent liabilities, we need to know that it's probable that the firm has incurred a liability, that this is probable, and then we need to know, if so, is the amount of the liability, is this reasonably estimable? If we can't come up with a number, if we can't come up with some kind of estimate for what this liability is, then we don't accrue it. Then we would just wait until we actually have whatever premiums or so forth are redeemed, and then we account for them just basically on the cash basis. But if these two conditions are met, if it's probable we'll have a liability, so if it's probable that people are going to return these box tops and want a toy, and we can estimate then the amount of that liability, what this is going to cost us, then we need to make an accrual. And so I'm going to show you how to do the journal entries and how we would account for that right now. So let's take an example. Let's actually use the example we were just kind of talking about here. You redeem box tops or labels or whatever, but let's say it's from granola. Let's say that the firm sells granola, boxes of granola, and the deal is that one granola box label, just that little label you cut off the box top, one granola box label, if you mail it in, you can get a free toy. Okay, so one label, one toy. So now the firm goes and sells, let's say 60,000 boxes of granola. Sells 60,000 boxes for $4 each. And then now the firm is going to have to estimate, and this is where that reasonably estimable part comes in. They estimate 40% will be redeemed. Now you might be thinking, hey, this doesn't make sense. They're giving away something free. Why wouldn't everybody redeem it? Well, some people might not have children, and they think, okay, well, I don't have any use for a toy. I don't really need this, and so why am I going to mail this in? So when you sell 60,000 boxes, not everyone is going to redeem it, and so they come out and say, well, we think it's going to be 40%. And so 40% redeemed. Well, what does this mean? Well, if we multiply 40% times 60,000 boxes, that's going to give us 24,000 toys. So that's the amount of toys that we estimate when we make these sales. We're estimating, okay, at some point we're going to have to give out 24,000 toys. And let's say that the toys cost us, let's say they were 50 cents each when we purchased them from whoever we bought them from. So now let's make the journal entries, and let's start with the most simple journal entry. We got to record the sale, right? We've sold 60,000 boxes for $4 each. So we just multiply this 60,000 by 4, and that's going to give us 240,000. Now let's say we got cash for this, so we'll debit cash for 240,000, and then we're going to credit sales or revenue, however you'd like to think about it, 240,000. But now here comes the accrual part. So we say, okay, but even though, so right up, we made these sales. Now we haven't had anybody actually redeem these labels yet, but it's probable that they will, and we can go ahead and estimate it, right? That's what this is about. We're estimating that we're going to have to give out 24,000 toys. They cost us 50 cents each. So we're going to have a liability here ultimately of 24,000 times 50 cents, which is 12,000. So we have a liability, an obligation of $12,000, and how are we going to account for that? Well, we'll just go ahead and we'll record an expense. We're accruing an expense, and we'll just call it premium expense. And then we're going to have a liability associated with that expense, and we'll call it premium liability. And premium is just the word we use for cereal box tops, labels, these kind of things. So this amount is going to be for $12,000. And this is being recognized in the same period that we have the sales, right? This is the same year. Let's say this is 2017. So immediately, before we even know, okay, we're going to have X number actually redeemed, we just make an estimate, and then we record the liability and the expense. And so this will go, we're basically matching the sales and the expense in the same period, right? Which makes sense. We're doing a good job matching here. And now you say, okay, well, what happens as people actually redeem these toys? As they actually send in their label and we give them a toy, what journal entries do we make then? Okay, well, let's say that in the next period or at some point they redeem, let's say, $3,000 worth of these toys. Well, we're going to reduce this liability account then by $3,000. If we think about this as like a T account and we've got $12,000 in the credit side, well, we're going to have to make a debit to the liability as people redeem. And let me just put here, this is as people redeem these cereal label, or excuse me, granola labels. We're going to say, okay, well, now we have to reduce our liability account because it's no longer an obligation. And let's say they sent in $3,000 worth of toys. There's still $9,000 remaining that we haven't sent or they haven't redeemed yet. So we reduce the liability by $3,000 as we actually perform the obligation, right? And what are we doing to perform the obligation? Well, we're giving out some inventory, specifically toy inventory. So let's put in parentheses here, toys. Inventory of those toys, those 12,000 that we had, or excuse me, well, 24,000 toys, but $12,000 worth since they were 50 cents each. So in any event, so we're reducing that by $3,000 as we actually send out the toys, right? We're sending out the toys as people redeem them, and so now our obligation is not as high, so we reduce our liability in terms of the premiums.